currently an MBA student at Georgia Tech, and I previously studied chemistry and mathematics at Georgia State University. I've been an avid day trader for over 3 years, and one thing that always stood out to me is something Peter Lynch said, which is, in this business, if you're good, you'll be right 6 times out of 10, but you're never going to be right 9 times out of 10. So, an executive summary of my fund/portfolio. There's a lot of moving parts that go into this, not just trading, but also your values, your culture, what makes you better, your comparative advantage, and your external constraints. This surrounds your actual model, the process in which you trade in your investments. Overall, I was able to generate over $3.7 million in post-tax profits, assuming a 30% tax rate. My fund returns were 531.90% over a 3-month period. I completed 100 round trips, the majority of them being day trades. I utilized zero leverage whatsoever, and I diversified across different asset types, which I'll dive into later. I also had a high reward with very limited drawdowns, and that will also be discussed in the upcoming slides. So first and foremost, when we're talking about our investment fund strategy, let's talk about sizing, the most important thing to me. I use a strategy called oversize sizing. So if I say one oversize, I'm talking about $100. So if I say 100 oversized, then I'm talking about $10,000. This is very important. As I get into trades, I try and minimize my sizing in order to not lose a lot of money in a trade. This is extremely important too when you're trading options on Thursdays and Fridays, when there tends to be a lot of volatility and option prices tend to go everywhere. Fund culture. So what do I believe in? I truly believe that math is the thing that drives the market on an intraday basis. Yes, you might have earnings report or news that come out, but generally speaking, there's a mathematical machine in the background that is selling and buying, that deploys opportunities for you to take advantage of in the form of technical analysis. Also, oversight. I have rules set in place for myself for my portfolio that minimizes any losses that I might have. These rules include having tight stop losses, maximizing my intraday trips, in other words, trying not to hold a risky derivative trade overnight, and also utilization of high probability technical analysis, so being patient and waiting for the right time to entry in accordance with what my technical analysis is saying. And lastly, my implementation. So overall, the implementation was limited due to the platform not letting me close positions after NK, for example, did a merger, or not having spreads and butterflies, but the true returns were 200% more, and I'll dive into that later. But trading strategy was implemented pretty well across the board, as long as I followed the 3 previous buckets. So, on the left side, let's talk about our performance. Like I said previously, we had 531.90%. Hypothetically speaking, our annualized return would be 366,220%. However, considering the fact that I utilized a lot of derivatives to get to this point, it would be very hard to achieve that because the options volume would not be present there. Clearly, I beat the S&P by a lot. My best day was 78%, and my worst day was only 8%. 8% is still a lot, but in relation to how much I made on my best day, it's pretty good. On the right-hand side, when we talk about my portfolio moving forward, it's very hard to incorporate all the options that were traded, as there was over 200 types of options traded in total, so over 100 round trips. So we're going to talk about our portfolio in 2 phases. First and foremost, the original portfolio with the intraday movements, and second of all, the equities, which I tracked separately and I kept in place. Some of the equities, as you can see on the right top chart, included Schlumberger, Boeing, 3M, AMC, Casa Sciences, Microsoft, SPY, and Immunity Bio, which used to be NK. I'm heavily diversified, majority being in industrials and energy, and I also tried keeping a lot of money since I was very quick to make a lot in the beginning. In general, just the equities in themselves made over 30%, as you can see in the bottom right chart. The beta for my fund was negative 2.590 with an alpha of 0.04, and the equities only, however, had a beta of 1.5 with an alpha of 0.004. Yes, this is extremely rare and a very large negative beta, but this is mainly due to the fact that I was trading a lot of derivatives. You know, it's not just based on the fact that I was trading derivatives, but also the fact that I was trading high beta equities that were trading with the market and against the market. And the most important thing is that a lot of these high betas that I was trading on Thursdays and Fridays had a lot of opportunities when they were gapping down. So I was seeing very large returns with very minimal inclusion of funds. So ultimately, this led to me having a portfolio that traded very against what the S&P was trading, since these tickers were trading disconnected from the general market breadth. Now, talking about risk. So we can see in the bottom left-hand side, those are my maximum intraday drawdowns. So essentially, what's the most that I lost from one day to the other? Considering the fact that I had over 900% at 1% and 530, to finish off, 8% and 7 and 7 3 times is pretty good. As I said, my drawdowns increase in frequency in the later stages of my portfolio when my active management of the portfolio slowed down. This was mainly due to the fact that I was unable to close my NK position, which was over $2 billion, and I entered at 19 and got to 40 due to the merger that occurred. Also, I was not able to close the options on that, so I stopped actively managing it at that point. But nonetheless, the returns were awesome. So I included on the bottom right my positive/negative ratio. The top one is with inclusion of the platform not working, and then the bottom is had I been able to close my NK trades. So also on the chart, as you can see, are my daily returns. This is based on the previous day's balance, not the overall general balance. So like I said, moving from March 15th to the end of the portfolio, at this point I had already done over 85% of the trades that I would have done for the whole class, but this is when I saw the majority of the volume of decrease in my portfolio due to the reasons I noted. So these are the charts here for the majority of the tickers that I traded the most. And I just wanted to highlight a couple of them and not go crazy with them. On the top left, we have SPY. So I don't actively trade SPY a lot, but it's something that I have to actively look at, as a lot of these move in tandem with SPY. Now, after Tesla bought Bitcoin, for example, Tesla trades a lot in tandem with Bitcoin. So the beta in association with Tesla and Bitcoin is now closer than it is with SPY in the last 2 months. One thing that I talked about in my previous presentation was that there was a 13-month ascending wedge on Tesla. And as y'all can see in the top right, it dropped down and now it's consolidating. We were expecting it to drop lower into the 300 and 450 range, but the lowest it got was 550. So I changed my trading strategy at that point, and that's the most important thing, that I'm able to accept market breadth and analyze the earnings report coming out in the future, and that they had positive numbers, and get out of the trade. So I'm holding that for now. On the bottom left is NK. It is a cancer company, and they merged, and now they're trading under the ticker IBRX. I entered at $19, and I was trying to get out at $40, but I was unable to do that due to the merger and the portfolio not allowing me to close my position. AMC is an interesting one. People called it a meme stock, but I entered AMC in real life at $2, and I entered the game right before it exploded. I believe there's a super cycle of movies. I believe there was consolidation over a 6-month plus period, and it was trading below its 30-day, its 50-day, its 100 and 200-day moving average. So I was able to take advantage of this, and as you guys can see on the chart on the bottom right, there was 2 bull flags that emerged, which allowed me to take advantage of this immensely and make a lot of money. Sorry, computer froze. Diving a little bit more into the risk analysis, so my fund had a standard deviation of 14.6% with a Sharpe ratio of 0.27 in comparison to the S&P's 0.94% and 0.76% Sharpe ratio. Yes, the S&P's Sharpe ratio is a lot higher. However, what I would like to note is that the max intraday drawdown is low in comparison to the large returns. And I think the Sharpe ratio takes into account a lot of the volatility which occurred was positive. It was not negative volatility. Like I showed earlier before, my best day was over 77%, yet my worst day was only 8%. Therefore, yes, the Sharpe ratio is low, but it doesn't take into account that a lot of my trades were closed intraday, and the fact that my volatility was due mainly to positive volatility. Another thing is when we're looking at the VAR, a lot of investment banks utilize this to be able to predict how much percentage of an odd you have to be able to move a portfolio in X amount. We did a Monte Carlo simulation, and we also did a 3-year simulation, and they all received positive returns anywhere from 1.5% to 3.5%, as you can see on the picture on the top right. The highest returns were seen in the communication services, and the industrials and information tech received the least. Now, when we're talking about risk analysis on our equities alone on the bottom right, we are extremely exposed in the industrial sector. I came up with a bunch of different scenarios such as the Russian financial crisis, the oil prices dropping, Libyan oil shock, or the euro going down. The worst scenarios you guys can see is the Russian financial crisis, 56.33%. One thing to note, this number looks incredible, is that I maintain full liquidity on my portfolio at all times. In a sense, not full liquidity, but the opportunity to have full liquidity. So the volume that I'm trading on a certain equity is always below the average moving volume for the past year. Therefore, I know that I have a high chance of being able to get out of the trade. And this is what I'm talking about. If you look at the top right, Bloomberg Terminal can run an analysis on your liquidity summary. So essentially it's saying that I can get out of all my trades with 100% within 1 day. So that's very good if something were to go down, especially with my active management strategy. I minimized my holding periods, like I said, and this was a big deal because risk is relative, and a lot of the analysis numbers, such as the Sharpe ratio, make you believe that there's a lot of risk involved, which it's all relative, of course. But I maintain full liquidity and control of the situation at all times. As previously stated as well, my sizing was conservative for a paper count at least. And my positions that I was trading on Fridays and Thursdays into close were 10% or less of my overall portfolio. I also believe that my risk was managed due to my diversification across different types of sectors and different types of asset classes. Another thing is that when I did Markowitz optimization and backtesting on the portfolio, it kept showing that there was a high a high chance of having exposure on the negative side to industrials. So right here, I just want to hit some of the key individual tickers that I traded in regards to how it compares statistically with the S&P or SPY. So we can look at Tesla, for example. Tesla had the highest positive beta, so essentially it's saying that Tesla's outpacing positively the returns of the S&P. Another one that's interesting to look at that I'm currently trading a lot, I entered $180 with a price target of $220, and the earnings actually coming out in the upcoming week, is Triple M, 3M. They make the K95 mask on the top left. They have a adjusted beta of 0.322. They're a high dividend retirement company. They have a dividend of about 3.5%, so the volatility is quite low on that. But this kind of leads to you having cheaper premiums, which allows you to take advantage of it. One of the downsides when trading this in the games, the volume for options was not existent, but I was able to generate over 500% on some of the options that I traded in a very comfortable trade that I knew had a high probability. NK at the bottom left, before the pullback that we saw post-merger, its beta was outpacing the S&P, but now it's dropped back down. Let's move forward. So, in conclusion, let's hit 3 points. The larger returns. So, the fund was able to generate very large returns because of technical analysis. The viability, in my opinion, of this methodology is very credible, and it's seen by the immense number of trades and the relatively small drawbacks. There's one thing to say, hey, you have large returns with 3-5 lucky trades trading options, but when you're trading 100 options and your biggest drawdown is 8%, I think it really puts into perspective how solid of a strategy it is to utilize active management and technical analysis. The Sharpe ratio, something we already hit. The Sharpe ratio is poor, but nonetheless, like I said, I don't think it takes into account that the volatility as a whole is largely positive in a lot of these trades. So Yes, it's low, but I believe that we maintained risk management, especially since all our full trips were mainly intraday. And the last thing, something that I already hit, but I wanted to touch again, was the negative beta. And I felt like this was largely, in fact, to my trading strategy. Once again, to highlight what that was a lot of the big tickers that I was trading were tickers that were moving disconnected from the general market, whether it be the NASDAQ or the S&P. For example, Tesla. A lot of my options money was made on Tesla, and it started trading a lot in tandem with Bitcoin. So when it was going up or down against the market, and I was able to get a gap up or a gap down, and I was able to make a large amount of money, it kind of goes into the beta calculation that I'm making a large sum versus on the completely different side of what the S&P is doing. So it kind of leads to the beta that I had. But I hope you enjoyed my presentation. I hope you have a nice day. Thank you.